Before we start, let me introduce our group members. So my name is Nur Atira. My members is Zafira. Next is Fatia Azman and Fatia Tamizi. And lastly, we have Nawar. So this is our group member. So this is a partial question. So we will answer 6 questions with hedging, arbitrage, spreading, speculating, basic option, and synthetic strategy. So for the hedging, we are choosing December 2018, which is question 3 KLCI. And next is arbitrage. We are choosing January 2013, which is question 5 is about FKB3. And next one is spreading. We are choosing December 2018, question 1, and it's about FKB3 too. And next one is speculating. We are choosing January 2013. Question 1 is about FCPO. So next one is basic option. We are choosing July 2017. Same goes to the synthetic strategy. We are choosing July 2017. So I will pass to the first question with hedging. We explained by the Fatiha Azman.
So, firstly, I will explain on how to calculate the question about hedging, where we choose the partial question December 2018, question 3B. Before we proceed to calculate the effective price, we need to list down all the information given based on the question. So, based on the question above, the amount of fund is 5 million. Today January KLCI is 1770. Today January FKLI is 1794. Then the price at maturity is later March KLCI is 1759. Later March FKLI is 1763 and the beta given is 1.2. As can be seen, the price at the maturity shows a bearish signal where the hedger is advised to take a short position, where it is advised to sell the FKLI March contracts now and then buy it later. To calculate the number of contracts, the formula is amount to H times with the percentage of H and time with the beta. Since the question didn't mention the percentage of hedging, so we assume that 100% amount to H. So the answer is 66 contracts. Once we calculate the number of contract, we can construct the table with the explanation, where today in January manage 5 million investment portfolio at current index of 1770 and expect to fall in March at column current market. While in the futures market column, sell 66 March FKLI contracts at 1794. For later, March, in current column, sell 5 million portfolio at current index of 1759, and in the futures column, buy 66 March FKLI contracts at 1763. To calculate future option in order to know whether it profit or loss, the formula is as shown in the slide. The answer is profit of 102,300 ringgit. While for the cash position, it is equal to 31,073 ringgit 0.45 cents. The net effect is equal to 71,226 ringgit 0.55 cent, while the effective price without hedging is equal to 1,505 ringgit 0.74 cent, while with hedging is equal to 1,536 ringgit 0.74 cent. To conclude, it is effectively with hedging where the amount indicates the higher value compared to without hedging.
So next one is arbitrage. As you can see, this is question from January 2013. So this is question 5 is about the FKB. So let's see what he wants. So he want to the proof the arbitrage is possible or not, and all of the strategy that are being taken. And lastly, he want to know is a profit or loss if we make in 19 days. So first one is you need to find the information for the question, and the first step is you need to find IFR, which is 1 plus I2 multiply T2 but divided 316, and you need to divide it with 1 plus interest short term multiply with the time short term divided 316 minus 1, and you need to multiply with 316 divided with T3. T3 is different between the long term period with short term periods. So the IFR that we get it is 6.6 is 9.63%. So for the step 2, you need to find the fair value. The formula fair value is 100 minus IFR. So the fair value we get 19.37 and is below than market price, which is 92.50. So is overvalue. So if the overvalue, we need to go over the borrowing requirement. So we need to sell much FKB3 and buy it later. So next is you need to find NOC, which is 10 contracts. So for the next step is you need to find the strategic arbitrage. So you need to draw a box which is content of cash market, future market, today and later. And you need to write down the contract with December or the March. So for the cash market, we need to borrow 10 million for the 90 save at 7.25% and lending 10,000 for the 180 save at 8.5%. So for the future, we need to sell 10 contracts at the 92.50. So for the later cash market, we need to roll over the borrowing 10,000 for the 90 stay at 9.63% as you get it from yearly. So why we need to do roll over? Because the first borrowing has reached the maturity, which is 1 month. So the lending is still ongoing. So the rollover borrowing will mature at the same time with the lending. So for the future, later we need to buy 10 contracts FKB at 19.37. So for the net spots, it's also have a same content with cash market, future market, today and later. But and on the cash market later, you need to change to 9% because the question is asking if the interest change is convert at 9%. So the future market for the later you need to buy at 91. And for the last step is you need to find the profit or loss. So for the future position is selling price minus with buying price and multiply NOC, multiply 100 specific point and multiply 25. Why 25? Because it is FKB. And for the cash position, for the interest payment, you need to um, fund multiply with the interest for the short term and multiply with the time period of time short term. So for the interest receipt, you need to fund multiply with the interest long term and multiply with the period long term. And lastly is interest payment. With fund, you need to multiply with the T3, which is different between period with first period and the long term period and the short period. So from the dates, you will get the profit, which is 57,500. So this is all from the arbitrage question.
Assalamualaikum warahmatullahi wabarakatuh. My name is Siti Nawara and I will be explaining on the topic of spreading, which we took the question on December 2018, question 1B. Here we can look the questions. Overall of this question contributed to 14 marks. So these are the answer of the A question on how the interest rate movements affect the interest rate futures market. Interest rate movements have a substantial influence on the interest rate futures market through various factors. Firstly is hedging interest rate risk can be achieved through the use of interest rate futures. Borrowers have the option to utilize futures contract in order to secure a fixed interest rate. These serve as a safeguard against potential future rate hikes, which could potentially result in higher borrowing costs. Speculators can also utilize interest rate hedges to take advantage of variable rates, which can potentially lead to profitable opportunities. Secondly, monetary policy transmission refers to the process through which changes in monetary policy are communicated to various interest rates in the economy, affecting the yield curve. The cost of borrowing for households, firms, or governments is influenced by the level and slope of the yield curve. This in turn has an impact on the interest rate futures market. Lastly, inflation expectations plays a vital role in the interest rate futures markets. Higher expected inflation can cause interest rates to increase. We move to the next question, which is, as a professional spreader, you decided to buy 6 lots of June FKB3 at 97.72 and sell 6 lots of September FKB3 at 98.19. Assuming in early June you decide to close out your positions at 97.02 and 96.99 for June and September contracts respectively. Identify the spread undertaken and show your spread profit if any. The commission is RM50 per lot. So, by looking at the FKB3 price trend, it shows a bullish futures market. So, the trader should buy low price futures on June FKB3 contract at 97.72 and sell high price futures on September FKB3 contract at 98.19. Next, to identify the spread undertaken, we will construct the spread strategy table as shown. We are calculating the basis spread by subtracting the June 2018 FKB3 from the September 2018 FKB3. The basis spreads were found to be negative 47 basis points and 3 basis points for June and September respectively. Next, to assess the spread profit, we need to find the profit or loss of each contract, which are June FKB3 and September FKB3. The formula is by subtracting selling price and buying price times with number of contract times with 100 basis points and times with 25 ringgit. Thus, June FKB3 resulted a loss of 10,500 ringgit, while September FKB3 resulted a profit of 18,000 ringgit. After that, do not forget to calculate the commissions as it was stated on the question. To assess the total commissions, we need to multiply the 50 ringgit commissions with 6 lots and 2 contracts. Why there is 6 lots? Because it has stated on the questions. And why is 2 contract? Because there is 2 contract involved in this question, which are June FKB3 and September FKB3. Therefore, the total commission is 600 ringgit. Last but not least, we need to calculate the overall profit, where we sum up the profit of June FKB3 and September FKB3 and minus with total commission. Thus, we can conclude the profit is 6,900 ringgit. This means that this spread trading strategy taking advantage of the rising market, resulting in a profit of 6,900 after considering all costs. That's all from me. Thank you.
Hi, my name is Nur Fatia binti Ahmad Tamizi. So for this part, I will explain about the speculating, which is January 2013, question 1, which is FCPO contract. So here, as you can see, the question mentioned about if this policy is pursued, the price for the commodity is expected to be adversely affected due to the undersupply. Moving on, the position is identified as a long speculating based on this question because it says that the price of this good will likely go down because there are not enough supplies. That's why the price is expected to go up. If a trader thinks the price will go up, they will buy future contract now, which is when the price is lower, and then we sell them later when the price is higher, which is buy low, sell high. For question 2, we need to determine the contract value. The formula is as follows, which is entry price equal 3,190 ringgit multiplied by the number of contract, which is 4 in this case, plus with 25 tone, which equal 319,000 ringgit. Next, to prepare the market-to-market position for the 5 trading day, assuming that initial margin is 10% of the contract value and all traders must maintain 90% of it. So, for the initial margin is 10%, multiply of total contract value, which is 319,000 ringgit, and the answer will be 1,900 ringgit. And for maintenance margin is 19% multiply of initial margin, which we previously calculated, which is 1,900 ringgit, and the answer will be 28,710 ringgit. After that, we need to make a market-to-market table. To begin, make a table like the one in the question that shows trading day and change in closing price. And then on the column closing price started from 0 day with 3,119, and then for the next day just add 10 like in change in closing price, which we get 3,200, and for second day, which is negative 13, we need to minus as previous number on closing price, which is 3,200 minus with 30, and we will get 3,117. And the same goes to other. If positive, we will add, but if negative, we have to minus. As we move on to the floating profit or loss, we need to use a figure like selling price minus with buying price, times with number of contract time, which is 25 tone, and for the first day is 1,000, second day is negative 3,000, third day is 1,000, fourth and fifth day both is amount negative 1,500. Next, for current margin, take it from initial margin that we just calculate just now, which is 31,900, and then for the next day 31,900 plus with the amount in floating profit or loss. Then do the same thing with the other. Just add the next day open profit or loss, and which is in this case the amount of 27,900, which is less than maintained margin, which is 28,710. That's why it needs to add 800 times. Next, for current margin, take it from initial margin that we just calculate just now, which is 31,900, and then for the next day 31,900 plus with the amount in floating profit or loss. Then do the same thing with other row, just add the next day open profit or loss, which is in this case the amount of 27,900, which is less than maintained margin, so which is 38,700, so that's why we need to add 810. To answer the last question, you need to find the total realized profit or loss up to the 5th day ending margin, which is 28,710 minus with the beginning margin 31,900, and then minus 810, and we get the loss 4,000.
Right to a holder. So it is suggested for them to do nothing and let the option expire wordless if at the expirations it is out of the money. Meanwhile, if the option is in the money and the buyer has forgotten to exercise it, his broker may exercise it on behalf of their buyer. So they are suggested to exercise the option when it is in the money to realize profit and sell the option contract and therefore close out his positions prior to maturity. So the next question, an obligation to an underwriter. So they have to do nothing and wait for the buyer to exercise his right or not. So they basically need to buy back the options and thus close out his positions prior to maturity. The gain or the loss will be the difference between the premium received selling options and the premium paid, which is buying back option. Okay, moving on to the next question, which is question B. Determine the correct option premium if the option is first a put option, second a 12 ringgit straddle. So the first thing that we need to do is to calculate put option intrinsic value, which is exercise price minus the market price, where 12 minus 12 ringgit 40 cents, then we get the answer negative 40 cents or 0 intrinsic value. Then calculate the put option time value, which is premium minus intrinsic value, where the answer is premium is equal to 18 cents. So for the next one, which is a straddle, a 12 ringgit straddle, there is two strategies that we need to identify, which is buy a call options at exercise price 12 ringgit with premium X, or buy a put option at exercise price 12 ringgit with premium X 18 cents. Then we need to calculate the call option intrinsic value, which is 12 ringgit 40 cents minus the 12 ringgit, which is 40 cents for the intrinsic value. Then we calculate the call options time value, which is premium minus intrinsic value. The answer is 0.58, which is, so the social premium for long straddle is equal to 0.58 plus 0.18, and the answer is 0.76 cent. Moving on to the next question, which is question C. The first one is long straddle. A long straddle is the definitions where a buyer buy a call and put option at the same exercise price. So the strategies for this question is buy a call option at exercise price 1750 at premium 5 and buy a put option at exercise price 1750 at 10 premium. So the tabular payoff table, we have here market price 1,600, and then we have here long call at 1750 premium 5, and we have long put at 1750 premium 10, and we have the last one is long straddle net profit or loss. For long call, it is in the money because market price is above the exercise price. So when the buyer exercise the options, they will profit 45 ringgit. While for the long put, we only the buyer only lost to 10 ringgit because the loss only limited to premium. So for the total long straddle net profit or loss, the buyer will profit 35 ringgit. Okay, this is the graphical payoff of long straddle, where the buyer can profit when the market price is above the exercise price and the losses only limited to the premium. Okay, the next one is short straddle. Short straddle is a situation where a seller sell a call and put option at the same exercise price, where the strategies made in this question is sell a call options at exercise price 1750 at premium 5, and the second one is sell put option at exercise price 1750 at premium 10. So the tabular payoff table is the first one we have market price, which is 1,600, and then short call at 1,750 at premium 5, and we have short put at 1,750 at premium 10, and the last one we have short straddle net profit or loss. So when the situation market price is above the exercise price, of course the buyer will profit, which is in the money. The seller will suffer a loss, which is the formula is exercise price minus the market price and then plus with premium. The seller only have premium. So the total short straddle net profit or loss for the seller is negative 35. So this is the graphical payoff of short straddle, where the seller profit only limited to premium, while the loss is when the market price is above the exercise price.
Thank you very much.